there's a lot of information out there right now on Twitter, and I've read it on Reddit as well, that RSPs aren't actually useful, but it's just not true. I think those things come from just trying to get clicks and people's eyeballs. But RRSPs are a tried and true way of saving money on tax and saving for your retirement.
Well, welcome to the Steadyhand Coffee Break series, where we dive into matters of finance that matter to Canadians. Whether you're planning for or living in retirement, or frankly, retirement's not even on your radar, I hope you'll find our topics and discussions helpful. And if you're new to our channel, be sure to look around. If you like what you see, please subscribe and click the notifications button so you can be alerted as soon as we've uploaded new videos. Now, today we're discussing Canadian taxes, and we're releasing this video in the final few weeks before Canadians must file their taxes for the 2023 tax year. We're very fortunate to be joined by Victoria, BC-based CPA and co-founder of Avalon Accounting, Joe Collins. Joe and I will be overviewing the top 10 tax tips that we have assembled. And I say we've assembled because Joe and his team have a much more extensive list of 29 tips, which he covers in a separate video, as well as lots of related materials on his website. And we'll provide links to Joe's website in the video notes below. But we thought it would be helpful to carve out what we thought were the top 10, the ones that are most important and most applicable to the most Canadians. Joe, it's great to have you on the Steadyhand Coffee Break. Welcome.
Awesome. Thanks for having me, David. Happy to be here.
Well, let's start with a little bit about your accounting practice, including the typical profile of your clients.
Yeah, we typically work with small business owners, anybody that's looking to grow their business to $1 million, $5 million. We like to be included in those kinds of journeys where starting with an idea and then building wealth and a good lifestyle and all that stuff. So yeah, we work with corporations mostly, but we also do personal tax returns for our business owners as well.
Okay. So it sounds like you have a focus on small businesses with the idea that you effectively become their outsourced chief financial officer, which effectively allows businesses to do the business and not worry so much about the accounting. Is that fair?
Yeah. So we cover all the compliance stuff, but then we have CPAs on staff, bookkeepers, payroll specialists, just to take care of all the stuff that comes up. And lots of stuff always comes up with finances and small business. So we're busy.
Before we get into it, one more thing. What's the difference between a CA and a CPA?
Yeah, that's a good question. So a few years ago, there used to be 3 designations in Canada. A CA was a chartered accountant. Then we also had CGAs, if you've heard of those, certified general accountants, and CMAs, which were management accountants. And the CPA brought all of those different designations together under one designation and standardized the training and coursework that we all had to do.
Okay, so it's all standardized under CPA.
Yeah, that's right. Yeah.
Well, that's great. So let's dive into the top 10. What's number 1?
So number 1, and this is in our video, and I think we kind of make a joke about it because it is something that just seems very obvious, but it's just file and pay your taxes on time. And there's it seems so simple, but it's also not obvious for everybody because we see lots of people filing their tax returns late, paying late fees, and penalties and interest that is really not needed. So you should only pay the government what you actually owe them and nothing extra.
In your video, you actually note that something in the order of 40% of Canadians are not filing on time?
Yeah, and that number can be inflated a little bit in terms of penalties and interest, because if you don't owe anything, then you won't be suffering those penalties and interest payments. But still, filing on time means you get your GST credits in your bank account earlier. And especially if you're not owing anything, often that could be lower income Canadians that can get a lot of money back from filing their tax return on time. So really critical to do that. So we thought we'd get the obvious one out of the way, even if it's not so obvious to about 40% of Canadians.
Well, it makes sense. What's number 2?
So number 2, I'd say RRSPs. I think, there's a lot of information out there right now on Twitter, and I've read it on Reddit as well, that RRSPs aren't actually useful, but It's just not true. I think those things come from just trying to get clicks and people's eyeballs. But RRSPs are a tried and true way of saving money on tax and saving for your retirement. Or even nowadays, I think people take gap years or take a year off of earning, and you don't want years where you have no income. If you have RRSPs and you're 50 years old, you can take that money out and during that year and keep your marginal tax rate low, and take a gap year at some point. So it's really flexible that way. And I don't think Canadians often think about RRSPs in those terms, but they are still a very, very useful tool and are at actual tax deduction. So it's right off your income and you pay less tax in that year, which is great.
Well, I think they're not only a great device for lowering your taxes when you're, contributing to your RRSP, but they can also, as you alluded to, be a good tax planning strategy when you're either in or entering retirement. And there's something called the RRSP meltdown strategy, which I actually used with my wife's RRSP over the course of the last 10 years. And so she'll go into retirement collecting CPP and OAS and the other things without that additional RRSP income potentially affecting her her overall tax rate.
Yeah, that's great. I mean, there are so many different opportunities, especially, if you're working with a financial advisor that knows your situation really well. And we really encourage that with our clients, to work with somebody that knows their situation intimately, that they can take advantage of these kinds of things and make sure they have a unique strategy for them. And RSPs are going to be a big part of that, no matter what.
I think RRSPs are an amazing vehicle. And to your point, they're often misunderstood. And we hear from people who've been baited into those clicky kind of articles. So you're absolutely right to make that number 2. What's number 3?
Number 3 I have is charitable donations. I think, it can be overlooked a little bit, but often people are giving to organizations, and just understanding, what you get back for that. And it can often encourage people to actually give more. So I just checked out I think CanadaHelps.org. They've got a calculator. You can see how much money you can get back from donating. And I just plugged in $1,000 in there, and you get $400 back for that. So you can see some serious money back. You give 1,000 and you actually only have to spend 600. So pretty neat.
And in our business, in the last several years, the government has introduced the idea of gifting securities, which is a really cool feature as well. Can you give us a little bit of background on that?
Yeah, it doesn't come across our practice all that often, but it is a super valuable way to donate as well. So the fair market value of those investments, you don't have to take those into income and then donate them. You get the donation of the value, which is it can be valuable for tax planning purposes as well.
Our family donates a certain amount of our Steadyhand units to the Toronto Foundation, where we've set up a little family foundation. And so we pay no tax on the growth in those unit values. The foundation gets all of the value, as you say, the fair market value. And because we've gifted them to the Toronto Foundation, we get the charitable receipt. So it's a real win-win for sure. And I think making that number 3 is a great idea. All right, number 4.
All right. So number 4, I've got TFSAs. And again, it just seems so obvious to me, maybe, but it can't be overlooked as such a great tool for long-term tax planning, and also short-term. I think, you can use TFSAs to use for short-term savings for a lot of younger Canadians, I think, who maybe don't have the highest income yet and aren't ready to, start banking away their money for retirement necessarily, but maybe have some shorter-term goals. TFSAs are going to be the obvious one to go to if you're expecting higher income years later. The key is always still saving. I think you want to be forced into, I like RRSPs in a lot of ways, and that's why they're a bit higher on the list, is because it tends to feel a little more locked in than TFSAs. But, it's still a really valuable tool, especially for things like full taxation where it's not a lot of capital growth. If you're not expecting a lot of capital growth on those investments, but a lot of income happening, TFSAs are a great way to do that. Whereas RRSPs are, quite tax sheltered throughout. So capital gains aren't that useful there, but you can, use a strategy where, if you've run out of room on your RRSPs and TFSAs, you can use non-registered funds for more capital growth type things where, if you filled up those two things.
And the idea behind that is you shelter the most highly taxed sources of income, being interest income, followed by dividends, followed ultimately by capital gains, in the right mechanism, so that if anything's left over to invest in a non-registered, you're focusing more on capital gains there because of the 50% inclusion rate.
Mm-hmm. Yeah, but I think still, just such an important part of any wealth building strategy is to use TFSAs, and the flexibility around them just makes them such an obvious choice for a lot of Canadians.
In our work with clients, we often frame the TFSA as potentially being the last account that they'll draw upon. So in many situations, the TFSA is part of their intergenerational estate planning exercise. And so you can think about putting some some sort of riskier kind of investing in the TFSA. So for example, you could have all equities, with the idea being that you can withstand the volatility of equity returns because it's of the timing, the long-term nature of the investment, with the expectation that you're going to achieve higher rates of return ultimately over that long period at zero tax. So that's another thought for TFSAs. And one of the challenges that Canadians have is that the TFSA was, I would argue, incorrectly named TF Savings Account. It should have been the TF Investment Account, in order to encourage people to think more holistically about the opportunities of what you can put into your TFSA. All right, so from thinking about gaining to potentially the opposite, what's your fifth tax tip?
Yeah, I've got investment losses here, just because I think there's a mentality, that you kind of forget about your losses and focus on your positives and your gains. But investment losses are very important to track. Not often people are tracking these for you. So, especially if you're in a self-directed situation, you want to keep track of any investment losses that you've had. If you make an investment decision to sell something because you don't see the value in it and there is an overall loss on that, you want to keep track of that, because you can either carry back those losses to prior years or carry them forward until you have a capital gain later to apply those losses against and save on tax. And the numbers can be huge. It can depend on the size of your investment portfolio and the losses that you're dealing with, but it could mean a lot of money.
Carrying a loss back sounds complicated. Is it?
Not really. No. You can do a T1 adjustment for these, and they're pretty straightforward. You're applying a loss against a past gain, and it's really just a quick form that's filled out, a T1 adjustment, and can be quite straightforward.
So don't be intimidated by taking this year's loss and applying it to last year's gain.
That's right. Yeah, it should be a fairly straightforward process. It's all within the law, and there's forms to fill out. And as long as you're, keeping track of all those things, you probably be questioned on these things. So they might ask for support. But as long as it's all on the up and up, it's all good.
Good. Okay. Cool. All right. What's number 6?
I just want one more thing on investment losses too. I think we want to touch on is, there are circumstances where you have to be a little bit careful on investment losses and not sell things and rebuy them right away. So they're called superficial losses. And I think there's generally sometimes we think we can outsmart the government, but they've generally thought of these things. So if you think you want to, it's on a loss and it's on the downward trend, you want to, crystallize some losses and rebuy those because you see some potential in the future. Those can be disallowed. They will be disallowed. So watching out for superficial losses, and not, I think as a general thing, not actioning items just because it's going to save you on tax. I think, it's supposed to be the other way around. You're supposed to do things naturally and then file your taxes accordingly and not do things just for tax purposes.
Okay, yeah, good point. Superficial losses, yeah, for sure. You need to be aware of those. So what is number 6?
So next one, I've got the disability tax credit, and the reason I put it on here is that it's can be broader than a lot of people realize, and anytime you're dealing with even mental function that's inhibited for a long period of time, or children with learning disabilities, things like that, it's a little broader than I think a lot of Canadians realize. Yes, there's some steps to go through, but it can be quite worth it, especially if you're looking at having to support a child or a loved one with their disability and the extra cost that comes along with that. Having the disability tax credit can be super helpful for that.
Can you give a very brief little case study or an example?
I'm of an age, so I know a lot of children in my kids' classes and that have learning disabilities, for example, and the trend around is to have their that have them evaluated by psychologists to help with their learning disability, to give them the supports that they need. And a lot of times, if they do have a significant impairment, whether with ADHD or dyslexia or other things where they need additional supports, these can be it can be evaluated by a doctor, and you can get a disability tax credit in those circumstances, which I think a lot of parents kind of, they see their child as whole and the person that they are. And of course they are all those things, but there's also help and support from the government, which it can slip through the cracks and be missed.
Okay, and so that disability tax credit can help to pay for or somehow finance some of the potential additional expenses that are required to support the child.
Yeah, it's a tax credit, so you can reduce your tax bill, which is obviously very important. But it also opens you up to other kinds of medical expenses that wouldn't necessarily be deductible otherwise, like therapeutic tutoring, things like that.
Well, on a similar note, for the broader population, what's number 7?
So number 7 here I have as medical expenses. So along the same lines, but a lot of things can be covered by health benefits, but a lot of people that we work with are self-employed and have to pay for their own extra medical and dental expenses. So really critical to keep track of those. There are some limitations, and you have to spend over a certain percentage of your income before it becomes eligible, but still can be a super valuable tax credit and reduce your tax bill by quite a lot, especially if you have a family member or yourself that's going through any larger medical expenses or dental as well.
So at my age, you're often faced with this idea of an implant, that dental implant, and that thing can run like 10K. It's highly unlikely that your insurance coverage is going to cover that. So would that apply?
Yeah, so anything like that where it's required for medical purposes, and you've got the receipts to back it up, you're good to go, and those should be kept and then filed with your tax return.
Number 8 wouldn't have made it onto your list last year.
Yeah, so it's a new one, and that's why I wanted to mention it. So this is the first home savings account. It's generally for younger Canadians, I guess, buying their first home, but applies to anybody, and it combines sort of TFSA and RRSP, but for buying your first home, and first home. That can be a little bit argued as well, because there are just time limits on home ownership. So if you haven't owned a home in a while, you can still get this home savings account and save up for your down payment and get the tax deduction. the growth can be tax free, and it can be 15 years ahead of time. So, especially, if you're a young Canadian, starting to put money away in a first home savings account can really pay off if you're, 10, 15 years away from your first home purchase.
So we've got four really pretty good tax deferred or tax free investment accounts or savings accounts that the government has created over the last, say, 40 years. We've got the RRSP that you referred to already. We've got the TFSA you referred to already. We've got the RESP for educational savings that we haven't talked about today, but that's a great account for families looking to put money away for their children's post-secondary school education. And now we have this FHSA, which is like an RSP. It's the best of the RSP and the TFSA sort of combined. So we got some really good account structures to help Canadians put money aside and invest for future and their family goals. Talk about family number 9.
Number 9. Okay, so this is topical. So the multi-generational home renovation tax credit. So I think with our current aging population, I feel we're entering this sort of sandwich generation. We're caring for our parents are getting older and caring for older parents, and also our kids at the same time. But there's some advantages to that where you can bring them into the same home and have childcare, keep people active and the family together. So the government's sort of encouraging people to house together by this having this renovation tax credit, which is helpful. I think it's up to $50,000 of it's not $50,000 they're giving you, but it's 15% of $50,000, so $7,500 as a max, and it's a refundable tax credit, which isn't that common. So you can get money back on this, even if you haven't paid all that tax, it can be super helpful. So if you have are having trouble housing your parents, or your parents are having trouble housing you, then this can be a very useful tax credit to have to update your home to have a suite that a family member is going to live in.
Okay, I imagine there, as you say, there's a lot of that going on with the cost of housing in general across the country. The other thing that's very expensive, and there's been some reporting on this in the last year, is the cost of raising a family. And I know you've got a couple of kids. Tell us about how you're taking advantage of the childcare expense deduction, your 10th tax tip for 2023.
Yeah, number 10. So childcare expenses, and this is huge, and it's been huge for me and our family for a number of years now. With 2 working parents that you have, even when the kids are in school, either before school or after school care, or both. And then you get into summer camps and spring break camps, and it feels like pro-D camps, because it feels like there's a day off. Couple days off every month, and then 2 months in the summer. So getting your kids cared for during that time can really add up as an expense. But luckily, that can be applied on your tax return, and you get some money back for spending money on that stuff. So that does include summer camps and things. So you're sending your kids to somewhere where they're going to be learning and doing sports activities or things like that. But as long as it's the primary function of it is childcare, so you can earn income, it's a tax deduction as childcare expense, and really does add up.
No kidding. Well, Joe, thank you for sharing your insights and your knowledge on this timely but frankly complex topic. I know a lot of us really do struggle around this time of the year. And if people are interested in knowing more about the work that you and your colleagues at Avalon are doing, or the enormous, frankly, amount of tax tips and education that you guys are providing, what is the best way to get in touch with you?
Yeah, so YouTube is kind of our first touch point for a lot of people checking us out. So we do lots of videos on that, on building a business and just understanding the Canadian tax system, all for Canadians. But otherwise, our website, avalonaccounting.ca, we've got lots of great blog posts and some guides to download. We just want to be helpful to as many Canadian business owners as possible. So yeah, check us out there.
Awesome. Well, in preparing for today, I can assure everybody that the content that you and Paul and your colleagues are providing is really top notch. So I congratulate you on that initiative. And thanks everybody for watching today. And be sure to leave any comments or questions that you might have on today's coffee break. We'll do our best to acknowledge and answer them. And again, I invite you to subscribe to the Steadyhand YouTube channel and ask to be notified whenever we load up new content. And some of that content does relate to one of the topics today, which is the FHSA. So if you haven't yet familiarized yourself with that new account, we have a couple of great videos on our channel that will inform you. And if you want more tax tips, as I said, be sure to watch our longer form Steadyhand Cafe on taxes that we recorded last year with the Globe and Mail columnist Tim Sesnick and Cynthia Kent, an advice-only financial planner, which we'll also link to in the video below. So thank you, everybody, for watching. Bye for now.